All right, we are back. Secondary market session. Rob Pieklo from AFR, just delivering a lot of knowledge, breaking down how it actually works on the secondary. And today's session is one we were already joking about because of the amount of just, I don't know if it's misconception, Rob. I don't know what it is, but why do you think the acronyms, all the different levels of all the different levels that we have to deal with, whether it's Fannie, Freddie, FHA, VA, why is there so much confusion around who runs what, who controls what, and who makes the rules?
Yeah, this is not a political statement. I'll start with that. So I'll
No.
just say there's too many agencies. Like there's just way too many, and the acronyms are too similar. And we joke all the time, and we talk about it. Even our own internal team had some confusion around who does what. But on the broker side, we see it all the time. We see so many different questions and people asking about something and just having just really the wrong agency, the wrong side of the government who would even support or help that. So it was like, you know what, internally with my own team, we were like, there's some confusion around it. So we created something called Mortgage Minds, and we do it internally every month. And this was one of our latest topics. And I thought it was going to be like, kind of most of the people know, and it's not really a huge value add. It was a huge value add. People did not know how it worked on both on origination side to the back end and who's in charge of what. So I was like, you know what, this should be part of our secondary sessions and talking through who does what in the mortgage space with our government.
So let's start 30,000 foot view here. Who are the main agencies? What does that look like? Just can you tell us? Can we start there with the basics?
Yeah, absolutely. Well, first, since it's secondary, I'd be remiss not to talk about like the math behind some stuff too. So when we talk about terms and I'm going into acronyms, everybody, a BIP is 1% of 1%. I wanted to get that out there.
No, good call. Honestly, no, great
so
call.
BIP is 1% of 1%. So it's pretty easy to think of it that way. So when you're talking about BIPs, and a tick in the secondary sessions is actually a 30-second. So in our world, when you trade in ticks, but pricing is in BIPs. So it gets confusing, but that's what we see out there. I want to clear that up with everyone before we get into the government acronyms here. But we have Fannie Mae, which is obviously we know Fannie and Freddie. So Fannie Mae, Freddie Mac are the GSEs. That's considered the government sponsored entities, and those are companies that we'll kind of get into a little bit, but they were created by the government, and they were private companies, and they went under conservatorship in 2000, post-crisis in 2008. But then we have HUD, which is oversight. It's a housing and urban development. We have VA, we have FHA, we have USDA, we have CFPB, we have the FHFA, which makes everything really confusing because they use those letters. And then so we have those agencies, and each of them have a different function in our environment. Those are the main we'll call them culprits in the mortgage space. Now, the mortgage space for the United States is just different. I know a lot of people talk through like, oh, it should be like these other countries. These other countries don't have this kind of backstop. And they don't do things at the scale that we do them on 30-year fixed rate mortgages. If we had a completely private market and used banks and did stuff, there'd be a lot more adjustable rate mortgages. If you go to like Canada, it's a lot of like ARMs that are 15-year or 20-year loans. Like this 30-year fixed rate mortgage is something that's different. So we have to appreciate the government's involvement by having the liquidity and kind of insurance and provide some. I would say they have the backing, so it gives confidence for investors to invest in the securities that we're creating. So that's what these agencies do.
So I'm dual citizen, Canadian citizen, so very familiar with Canada and their housing market. A lot of family over there, only in adjustable rate mortgages, and the government basically, it's really hard to stand up a broker shop in Canada, just for anybody out there that's curious, because of how much control is by the government. So to his point, we are grateful. There is a lot of great, opportunity with what we have here on our side of things. With that being said, though, there are still some nuances, still some pain points. So you broke down, obviously, Ginnie Mae, Fannie, Freddie, GSE, and the way that formulates. When you're talking to loan officers and brokers, I think I know the answer because I think I deal with it too. Do you find that at times there's confusion between Ginnie Mae, Fannie, Freddie, where you're running findings through how that actually works?
There's a lot of confusion on it. Ginnie Mae separately, let's kind of pull that aside, because Ginnie Mae is it's just basically the back end of government financing.
Yep.
Right. You have to think of it this way. So when you have Fannie and Freddie are kind of in charge of the origination rules, origination guidelines. They handle when loans close, they're involved in the purchasing and backing of the loan. So they're involved in the insuring part of the loans, but also they handle the securitization part of the loans. In the government side, it's a little bit different. Ginnie Mae, their responsibility is solely the investor buying the securities and making sure the things that go into the securities are eligible. Yep. So we have FHA, VA, and USDA loans go into Ginnie Mae securities. Fannie and Freddie go into UMBS or Fannie and Freddie securities. So that's where those go into. Ginnie Mae handles just the back end. And oddly enough, for the amount of staff that they had at one point, I think it's still the case. There may be some AI companies doing more now. But in terms of profitability per employee, if they stood alone, they'd be one of the most profitable companies per employee in the country, because all they do is collect a nominal, 6 basis point fee on every single loan.
He said nominal.
Nominal.
Every single one?
Every single one. They have and it's based solely on the investor and the people investing and making sure they're protected in their investment. And the payouts are just like, they don't really happen. So it's just ringing the register at 6 basis points, and whatever commitment authority that we have to pay. We have to pay to get access to Ginnie Mae. You have to pay for commitment authority. You pay up front. And then on your loans, that's why when we talk about servicing rights, Ginnie Mae, if you have a loan that has, say, 50 basis points in servicing fee, we do all of our math on 44 basis points. So when you see Ginnie Mae servicing strips, they're never 25, 37 and a half, and 50 basis points. They always take 6 basis points off, and all the math is done off of that remainder. So you'll see 19 strips, you'll see the 44 strips, and that's what those things are. So Ginnie Mae handles the securitization piece, the insuring of the security and the investment from people, and that's their function, and that's why they're so profitable.
Well, I just learned something pretty heavily right there on my end. So that's a big win. I did not realize they even collected 6 basis points on everything that comes in the door. And there's nothing. I mean, that's just is what it is. That's just basically pay to play kind of situation.
We don't even
talk about it.
It's just the remittance happens. They collect their fee, and it's just they just ring the register.
So I am a big believer in post-COVID education. Here's what I mean by that. I believe that the mortgage space has been inundated with educational pieces that we've never seen before since COVID. The reason why is people couldn't go out. So you saw a lot of people doing long form YouTube and all this different content. So now what's happening is consumers, the access to information is getting easier and easier. We're seeing a lot of it now, even Chat GPT, with the amount of additional users that are being leveraged, and now all this information's out there and it can extract it. The reason I mention that is, how are you watching and seeing mortgage brokers change or the way they approach a conventional versus FHA loans? In some instances, I have people pricing out FHA because it's actually priced better, even though the consumer's 740 FICO. Right. And most of the time before, you wouldn't do that. But now you're seeing these changes. So with the additional education and information, what are you watching?
So I see, and this is just my take. Okay, this is my opinion. This opinion does not reflect the stance of AFR. I'll use one of those disclaimers. But in general, when I see a lot of originator material, a lot of originator marketing around this and decision making in the process, I honestly think that we do way too much in the weeds assumptions of what these acronyms mean. Like we go through, there's a loan and there's going to be a payment, and like going into FHA and going into conventional and going into the weeds of stuff and throwing out the like, I see a ton of acronym usage. I have some smart friends in finance, and I start talking a little bit about this stuff, and they're like, what the hell are you talking about, Rob? Like they don't know, and they're like in the middle of this stuff. So I think sometimes you want to educate, but you also don't want to go down the rabbit holes of DTI and LTV of this, and we're doing this because of the DTI of that. And like that's breathing to us, but the consumer, they're just buying a house, man. Like they're just refinancing or buying a house. Like that's just what they're doing. So why are we getting so much into the particular product and nuances to a product? We have to keep it a little more simplified, because the consumer doesn't, not that they don't care. I'm sure people want to know and learn about it, but I think getting into this, you need to know it. So when you get questions, you can answer it intelligently, but I would not go out and market in some of these things about these particulars of the loans, other than saying you have a great program that does this. You have a great program at 3.5% down. You have a great program at 3% down. We have this amazing thing that gives you the best pricing. If you're a first-time home buyer, you get to remove all these pricing adjustments. You can talk through that versus getting into like LLPAs and Fannie loan and Freddie and stuff. That's not in the consumer's vocabulary.
I wholeheartedly agree with you on this. So I know you made the disclaimer on your side, but I talk to my LOs about this all the time. It's like, okay, what's really important and why is it important? And then the other side of it is, do you actually know what you're talking about? That's the other part that's scary, because, hey, maybe maybe you go down a path and you become the social media person and it blows up, and then someone goes back and looks at a video of you talking about something you have no idea. It really will ruin your credibility. So just if you do decide to not heed the warning, just be concise, be specific, and make sure that if you get challenged on something, you do know how to formulate an opinion and can educate somebody properly. What we don't need is wrong information. What we don't want is wrong information out there. That's just scary for all of us. So please be careful when we go down that path. I will ask this. A lot of times I have people ask, right? Guaranteed insured. What's it mean? This government has backing to us. What about Fannie and Freddie? Is there no protection on Fannie and Freddie then? What does this mean if you're really trying to break it down, a guaranteed versus an insured loan?
Yeah. So at some level, like 90+% of all loans have some kind of guarantee or insurance from the United States of America. Like they have the credibility and the backing of that. On the conventional side, you have it through the conservatorship, and there's an implicit guarantee on loans. So when things go bad, the way it works in the Fannie and Freddie world is if you did the underwriting right, if you did all of the things correctly, the person who owns the servicing at that time, if something, if there's any amount of cost, or maybe they lost money because they had to foreclose and sold a home. Granted, that doesn't happen too often because the delinquency rates are so low. However, if they do it, the Fannie or Freddie, the agency is going to make that servicer whole. And then that servicer doesn't have to come back to the originator and say, hey, like you owe me this or that. Now, if things were originated incorrectly, there may be a bill and something goes in if it's done, wrong. However, if there's something that happens, if it's done right, if it's originated properly, it's still within the window, things occur, that servicer is made whole. So if they had to front $50,000 or $100,000, they're going to be made whole. So there is a backing when it comes to Fannie or Freddie. Why it's different for them is just they handle all of it from soup to nuts, from start to finish. They're the ones that are in charge. They're in charge of the investor side of it. They're in charge of the security. They're in charge of the origination insurance. They're in charge of the guidelines. They're in charge of what drives the guidelines in AUS. So like there are those functions all occur within Fannie or Freddie. Now on the Ginnie side, it's a little bit different. Ginnie has compliance rules for lenders on how much of something can go into a pool. They had an issue on prepayment speed, so they came up with the rule with VA in terms of the 210-day rule, saying like, hey, like we can't have a liquid market in these securities if these things are being paid off so quickly. When rates move, we need to have a certain time frame where at least investors can feel comfortable in purchasing these securities, because the investors do matter. So the Ginnie has that in mind, and they handle that side of it. So we have to stay within compliance with Ginnie Mae. A lot of that has to do with liquidity, having enough money that if something goes wrong, that the investors get made whole, and that we're not over our skis in terms of the servicing rights, because Ginnie Mae needs the servicer to be in business to then collect their fee every month, right? So as that servicing fee comes in, they collect their 6 basis points. We're doing remittances to Ginnie Mae, and Ginnie Mae then takes the money and disperses it to the people that have invested in those securities. So so that occurs, they get their fee, and that's how that structure works. Now, on the front end of that, the origination side, if something happens on the origination side, Ginnie has no say, right? There is no Ginnie Mae is going to come back and give you a repurchase because of the loan being done wrong. No, it's the insurance companies there, or the guarantors are going to do that. So you have FHA has an insurance, USDA and VA have a guarantee, and they're treated differently. But really all they're doing is covering the servicer at that time for losses, as long as the originations are done right. Now, FHA's insurance policy, what's good about the servicing in government, or the insurance and the servicing side in for FHA specifically, is if somebody buys servicing and they have servicing there, FHA makes the servicer whole if something goes wrong. And those have a higher delinquency rate. There's more foreclosures there. There's lots of different ways to work things out with borrowers as well. So like there's a process that goes on. As long as you're doing the servicing part right, you don't have to worry too much about not getting paid or not having claims be paid. And when I say claims, is the servicer has to front all the money. And then at the end, when the sale happens, there's like a final tally, you submit that, and then you get the reimbursed for what you lose from the servicing side. So FHA has that. Now they then, if they incur losses, they can look at the loan file and come and go to the originator and say, hey, originator, this loan doesn't look like it meets guidelines. We think you should pay us the money that we had to pay to the servicer for the loss. Or if it's not in that stage yet, if it's simply a loan's kind of delinquent, and they look at it and they say, hey, we need you to sign this letter as an indemnification that if something does happen, you're going to cover the losses. And FHA would, they treat it that way. So there's an origination side, and that's the insurance piece for FHA, that they're looking at the originators, the ones that signed off on that loan's underwrite. So for us, if we're doing a broker transaction, it's us that has to deal with anything that occurs on the back end, if it's done correctly or not. And then we would then sign a letter saying that we guarantee if something goes wrong, we did this, we messed up this underwrite. If something goes wrong, we'll cover the losses in the future. And then they can send us a bill. And they do. They send you a bill if you did something wrong, and you pay it and you move on. VA, somewhat similar, but there's caps on what you can get coverage for, which is why VA sometimes is treated a little bit differently, why people don't like taking significant risks. It's more so on the servicer side than it is the origination side, because there's only going to be a certain amount that they're going to cover. And we've seen it where there's been a VA loan that had, it's a $250,000 purchase that over time, you think like, how do you lose more than 25% on something that's just $250,000 as a purchase, and you sold it, you foreclosed and had to sell it? Well, it's not as simple as they go delinquent and you get the house.
Correct.
They go delinquent, and then things start to add up, taxes, insurance, and it may take years to then go through, and you may end up with a $200,000 loss on a $250,000 loan. Well, that they don't cover all of that. Therefore, the servicers are reliant on the origination side, and then maybe the originator's not around. They have to run their models as if you're not going to be around, just in case. And that's why you'll see servicing differentials in those types of loans, because the guarantee doesn't necessarily cover everything that might happen for the servicer. So you may see people treat servicing in the different areas a little bit, just they're going to treat it differently.
I wrote down a bunch of questions here as you went through this. So the last part to me is very eye-opening, especially when it comes to risk on your side. Because the part I'd never, you don't really think through all the time is, you're right. And each state is different based on foreclosure laws as well. So you're dealing with state regulation on top of everything else that you're already dealing with when it comes to potentially you just foreclose on the asset. That's not how it works. And then you have to make up the interest payments. You have to make up everything that was missed. So whatever is left over, if there's anything at all, it's so small, and it's paying out all the other, back end payments that you have to pay back. That is mind blowing. The other thing I heard too on FHA is you have to cover the payments, is to what I understand, right? The lender does specifically up to a certain point. So how does all of this plays a factor into risk? And this is so cool and fascinating about overlays, or, hey, here's just things we just aren't taking a risk on. So let me take us down a journey, and then I have a couple more questions for you, if that's okay. But
Sure.
from a risk profile, first and foremost, how does that change the way you view risk? And then how do we then see that on our end? And is that lender specific? So AFR, they get something happens, a buyback occurs for XYZ. AFR puts a rule in place that says moving forward, we're not going to do XYZ. You see a lot of lenders do this across the board, but how does that differentiate your risk when it comes to how you're looking at rates and how you're putting it in front of us, the broker community?
Yeah, so there is a lot to it when it comes to running models and finding out what you've lost, taking the losses and then incurred, and then making a business decision on like what we want to charge for the potential losses in the future. So you may see changes in FICO buckets. You may see, when things start to go awry, you may have to, right now, I think we had to add a little bit in terms of our lower FICO bands. We were winning a little bit of too much of the lower FICOs. So we have to take a look at that because those do have much higher delinquency rates. And we need to keep our profiles in check. So we run percentages. We want to make sure in terms of what the overall market is, and we're delivering around the segments that we see. We know we're not going to be living at the top end of the range, but we don't want to be on the bottom. We don't want to be there either, because it's odd is that, a lot of these things, there's peer data that's out there. So a lot of these things are run based on peer data, meaning that you're compared to your peers. And you run it percentages based on what the country's doing and what your peers are doing. And you want to pay attention to those things and not get too far out of line. And then we have to make adjustments to pricing. Some things we made adjustments much better for some. And VA specifically, we made some pricing adjustments. We loved some of the performance of the higher FICO, larger VA loans. And
That's
stuff
awesome.
started to look really good. We're like, oh, wow. A lot of times it's, bigger properties and these people have great jobs and have money to put down. They just are choosing to use their benefits. Those borrowers are stellar. We love them. And it may look scary sometimes with the higher DTIs, but a lot of times they're carrying 2 homes, to get it done. And like,
No,
you're like, there's some really good paper out there that may not look great. So we're taking advantage of that. We do like that. But you have to make these changes all the time. Like I wish I can set it and forget it and not have to do any of this stuff, but then that'd be doing a disservice to the broker community when things happen. And we've been ahead of the game on VA, some of the bad parts of VA and pricing of VA. We've seen lenders that have not done what we've done. And eventually you could tell when that flip switch, when they realize they're doing something incorrectly and that these bids aren't going to be what they expect. Cause you see pricing and be like, whoa, that lender just changed their pricing by 70 basis points on this kind of loan. And it's like, yeah, we did that 3 months ago because we saw that coming. So our team is ahead of it, and we tend to be first with a lot of these changes that are occurring because it's just data. It's just data, and no one has anything that's special. A lot of times people are not in the know or haven't experienced the bids yet. We just get there a little faster based on our team and having some of the best capital markets people on the planet. They're ahead of it. But that's just how we have to do it consistently. We have to continue to do the models and continue to run it and price it, accordingly. And we do see, especially, I'll say it this way. It's hard to say it. Sometimes people can't believe that. I think I saw a post of complaining about another lender that were taking, it's taking 5 days to underwrite. And they don't want the business, and it was a manual 582 credit score loan. And I went like, my God, like UWM, you've ruined it for everybody. You've made things so darn good and easy that this is the complaint that somebody who literally, if you did those all day long, and this particular company does a lot of this kind of business, like if you don't go through every single line, and they go and they're going to default at a much higher percentage. That is fact. That's not making stuff up, not opinion. It's fact. When it goes south, the agency will then come to you and say, hey, you did this wrong. You did that wrong. They don't want to pay the claim. So It's like typical insurance. So like they don't want to pay. So they're going to find something. So they have to go through with a fine tooth comb. So you have to do that. And I was laughing at it going like, oh my goodness, like this is where we're at, where that loan is we're getting complaints that it's 5 days, but you can't just run that through an engine and just say, yeah, close it. So a lot of the times when there's, complaints, or I see the posts about a really tough loan and they're mad at the lender, this is why, because the lenders are held and are responsible. And when these things go bad, they have to pay. So that's the difference, with that. And I see that all the time. And that's, that's the why behind it. When you see lenders that take a little bit of time, it's the fact that, when things go bad, there's a check that has to be written, and the lenders are responsible if they do anything wrong. And that could be, I'm talking about small things. You'll be surprised. And then you have the part of it on the other side of it. Yeah. People ask all the time, like, why are you going so deep on the borrower? And like, because we're trying to protect against fraud. And a lot of times there's things that seem common sense wise, but we have a specific example at my past life at AFR where we had somebody who knew the system and they bought an FHA 4-unit and they never moved in, but they had it as that they were going to move in, and they knew the system and they knew the municipality. They knew how to do it. They filed bankruptcy at the right times. It took 4 years. They never made a payment. It took 4 years to foreclose on that house. People know the systems and game it. And that's what lenders have to deal with. Now I have a loan that the guy never moved in. It was fraud. The borrower committed fraud, not the person that gave us the loan. And the borrower committed fraud, collected rent from 4 units, never made a mortgage payment, just collected. And we couldn't get them to even stop the collection process of the rent. People were living in the property and they never paid their taxes, their insurance, or anything. And we got held and ended up taking a significant loss on that, obviously, for that. But people are trying to game the system and game us all the time. So that's why sometimes we go a little deeper on questions, or when something looks a little bit, we can't just sweep it under the rug and close it. These things do happen, and we're left holding the bag on something like that. And it's a lot of times the broker community or the loan originators don't know.
That is the most, you just brought so many things full circle right now for me. I'll just, speak from my point of view right now. I understood very, very good generalities of it and understanding the back end markets and the insurance piece of it. But now when you think about also the minimal margins that lenders are making, which is what we talked about in our previous session.
Math, my friend.
Yeah. There's what math, right? If you're looking at accounting, you're like, all right, we got this much left over, y'all. Okay. And how you're probably also getting audited constantly. You're having to submit constant financial reports just to prove liquidity constantly. All of this to make a very minimal margin and to play in a very competitive space right now on top of everything else. So
has the thought of like opening a taco truck and sell tacos for a living crossed my mind? Yes, sometimes it has. But no, I love mortgages. We're going to continue to do it. But you're right. It's when you're collecting a small amount, and then when you have like a lump sum $200,000 loss, there's a lot of small amounts that have to cover that. And then when you see like adjustments for FICO and you're like, wow, why is this such a big charge? A lot of the times, and this is the reasoning, is that just simply it's math. There is a proven, historical data and the analytics show that there's certain FICO bands, they default more, which opens up the window for losses. And well, if you did everything right every single time, you wouldn't have any. But we all do. We all mess up. That's how it is. Originations, people mess up all the time. You forgot about this job. You get the tax returns. You find out that there was some other job or some other business they owned, or they lost 10 grand selling stuff on Etsy. There's stuff happens when you find out during the process, and it happens to us too. And that's why they have to try and price accordingly. You're never going to be spot on, and sometimes they're profit centers, sometimes they're losses. But you try to mitigate. When something big does happen, you want to mitigate that by saving for it.
Yeah. And it's not like the government agencies are coming in going, yeah, this is a perfect loan. You're right. We'll take care of it for you. They're doing what every other insurance does, right? Hey, looks like you on the 1003, you got the start date wrong on their employment by 2 days. So yeah.
I love giving examples because people don't quite know. When you see this stuff, like flawless. I had a Fannie repurchase, or Fannie or Freddie, one of the two, repurchase that came out, and it was for some a picture that had a wet spot on a ceiling on a conventional loan. You're like, well, how could that possibly be anything? And we had somebody, we were like, okay, this is how we'll address it. We got somebody to go out in our underwrite. When we did the loan initially, we had somebody go out. They gave us the repurchase because the person that went out was just a contractor and they weren't a licensed plumber. And the appraiser noted that it was not an issue. The person went out and we addressed it, and they said that it was not an issue. They required us to go out and get a licensed plumber to go up. And the same thing they went into the ceiling and said there's nothing that was evident that was leaking. And then they were like, okay, and they rescinded the repurchase. But I got a repurchase to buy a $500,000 loan back because of a spot on a ceiling. And then you wonder sometimes when there's a condition that pops up and you're like, why are they asking? This is why. And when the agencies get stuck on something, and you see it with the big guys a lot more, where all of a sudden every loan at one of the bigger companies has like the same condition pop up, or they're not treating income a certain way, or variable income is done differently. That's not because they want to. It's because they got hit with something in an audit that said, do it this way. And sometimes it's rules by enforcement. Another lender may do it another way, but you got hit with an audit. You have to show that you've changed the way going forward. And I'll give you one more quick example.
No, this is great.
Like this with an agency, like right now for AFR, we are the only wholesale lender in the top 50 that does it this way. And I've been told, why do you do it this way? Well, we have the inability to change. When you extend a lock, everybody else just changes the pricing, right? That's common practice.
Yep.
You have a quarter hit. If you were at par, now it's $99.75, and the borrower has to pay the quarter, and that's it. It's just put in discount point or whatever. We're not allowed to do that because we were told that that in their findings, if it's extended for an extension, it has to be separated as an extension fee, completely separate from the pricing. Meanwhile, every other lender does it this way, and I can't go back to the CFPB and go, well, like everyone else does it this way. It's like, well, no, they wrote it up in 2022 and hit the company for it, said you have to do it this way. What am I supposed to turn? Granted, I know there's like 9 people left there, but you still can't go in. They haven't changed the rules, and do it that way. So it's frustrating when there's rules by enforcement, and that happens to us all the time. So you ever wonder why lenders are like, why this lender does it this way, or why is there so hard on some kind of income calc? It's not because the underwriters had a bad breakfast or something and they're cranky. No, it's the fact that they got, most of the time it's an audit happened and they got hit with something and they have to address it and deal with it a certain way. And that's why they have to take that interpretation, and someone down the street might do it completely different.
Well, and that explains so much about the, it's the risk front. Why would you change that policy? Like I wouldn't, think about if I'll call it your household. So your company, if you own it, are you not going to change your policy? Like, are you not going to make sure that a certified plumber goes out every time there's a leak or a potential water spot and an appraisal marked out? No, You're going to every single time. Please make sure this is a certified plumber that does this report, because you're not the one having to deal with that repurchase. And when he says repurchase, you have to understand that's different than like an EPO. So on the repurchase side of things, let's just say $500,000 for the loan. They might be able to do 70 cents on the dollar, let's just call it. So whatever the case might be, where they're trying to sell it somewhere else to some other investor, they're now losing 30 cents on the dollar every single step of the way. So that's what he's talking about from a repurchase. So they have to make sure they're putting in place whatever they're getting hit for. And unfortunately, it is subjective. It is going to be audit dependent on who you're speaking to. And it's the same thing for you as a mortgage broker. If you're dealing with state audits, each state just has different things. North Carolina, for us, we had to change our W-2. We had our HR company on there, right, that did our payroll. North Carolina came in years ago and said, nope, we're sorry, we don't accept this unless it's your company name on your W-2s. We had to change that for the entire organization just for the state of North Carolina. That's because if I want to do business in North Carolina, I got to do this for the rest of my company. That's a choice I have to make. So it's no different. I hope I got that pretty accurate.
Yeah, listen, PEO companies have thought they can jump into the mortgage space quite a bit, and they can't because of those rules.
No, and that's a big win, man. So I appreciate you sharing that, because I don't think a lot of people understand it. How do LOs deal with these? Like, what kind of pain points are they going to deal with, and how would you advise them even going and addressing something like this?
Yeah, I think having an open mind on certain conditions and understand, listen, we want to get loans closed. Like, nobody's out to not close loans. And a lot of time, especially our reputation in the past has been very difficult to work with. Won't do anything to save the loan. Like, it's very tough company to work with. And we've changed a lot of that, but we do have occasions where, you have people that go immediately back to that kind of time at AFR. And that's just not the case. Like, we want to get a loan in and done. And a lot of times I actually have made the argument that we should have less conditions because there's less documentation for them to look at in the future to pick something. So we want to meet the AUS and have the minimum amount of documentation we possibly can in the file going forward, as long as it meets all the guidelines. Like, let's not look to do like a feel good condition to make you get covered. And then on your side of it, what you mentioned before, on the plumbing side, for me, I find that ridiculous. So I will fight every single one of those. I'm not going to I have to make a business decision if I'm going to put in a rule that makes you do that exact thing every single time. Do I want a potential few $1,000 issue or $10,000 issue on one loan to cost me millions in revenue because I'm the only one that does it this way? In the future, like, I have to make decisions on certain things that I feel like if I am confident that we're right on something and to the core, like, that doesn't make sense and others don't have to do it. Yeah, we make a change. We may have them do additional QC or take a look at something, but we're not going to make it where we're standing out as doing something completely different outside of, like, I'm probably going to change that discount thing and extension thing too, because I'm like, no one else this is crazy for us to be outside of it. We'll get someone to say it's okay over there, but at the CFPB. But that's the difference. It's very, from a broker standpoint, just understand that these are the things that the lenders are dealing with all the time. We don't want to be this way on occasion, but that's what happens. Like, we're left holding the bag. And what you mentioned about, if I have to repurchase a loan and I have to turn around and sell it, what's called scratch and dent, that gets costly. You're right. It could be 60 cents to 90 cents on the dollar. And you sell it and you take that loss and that's it. And again, when margins are tight, like, that takes a lot of little bits of margin to pay for those big losses.
Yeah, we had one, a couple of years back, and we had the chance to refi the client, obviously, but it was tough, and it was from like 3.25 to, I think it was like 6.5.
Yeah.
And just flat out, we just went through the process. We called this guy every single day, like, yo, here's what you did. Here's why you can't. It just got to the point. I'll just be upfront, with the group. He did something he wasn't supposed to do. Our LO did exactly what he was supposed to do. He dug deep. He asked all the right questions. We record our calls. So thank God we had protection there. But to that point, it gets to a point, y'all, where you just have to hit somebody between the eyes as well as just kind of part of this.
Okay,
where we call them, here's what you did. If you don't do this, we're going to have a problem. And the client ended up refinancing and understanding. But if you don't get that chance, you're the one covering. No one's coming to save you. So for all of you out there that, can you just waive the CPO? Can you just wait? They don't get that same in return. Let me just be very upfront. The letters he was talking about from the IRS or whatever the case might be. Those are the types of letters that they're getting. They're getting letters that say, you must pay this. Here's what you owe us. Here's your timeline. And they have a short window to overcome it if they can. And so please just pay attention to that. He gave you a lot of great tips and suggestions, but just ask questions, seek to understand. Don't just point fingers and assume they don't want to close loans. It is the most ridiculous thing ever. I always tell underwriters, if I'm not on the same page, if my LO and the underwriter isn't on the same page, I always say this. I say, okay, when we're all on the phone together, first things first, let's find common ground. Does everyone want this loan to close? Everyone always raises their hand and says yes. Perfect. That's the common ground you share with every single lender out there. AFR being the other one, and they've done a fantastic job just changing the perception that they've had. And a lot of it has to do with the conversations that Rob is willing to have with every single person, whether it's good or bad. With that being said, Rob, we talked a bit about HUD earlier and the oversight that they have for everything. Are there any big initiatives coming our way to make originations? I don't want to use the word easier, but maybe give us a little more flexibility. Do you see anything on the horizon just from you being in all these meetings and conversations?
Holy cow. Yes. It was amazing. Actually, it was incredible. So I got to go and we won a couple USDA awards. So I spent some time with HUD and the USDA group, and then got to sit on an executive council for manufactured homes for FHA. So we're trying to solve for the affordability crisis, and they let riffraff like me in there, which was awesome. I'm very opinionated about certain things and what we can do, and they make things difficult. Not quite the same as a regular stick built or even modular. And we had some great arguments, great discussions. I will say this, I've been doing this a long time. I'm old, but I've never seen a HUD administration and USDA and FHA specifically, a team that was so, I would say, they're hell-bent focused on growing and making things easier for lenders. I was in shock, to be honest, listening to them talk about getting into the weeds, like meeting with the deputy secretary, Todd Lindsay, basically runs USDA, and talking through the single family platform. And we talked, every lender got like 10 minutes. And because I rant, that 10 minutes turned into an hour and like 25 minutes sitting in his office. And it was him hitting questions and inquiring and being like, how does this, like, why is it tough for you for this? Would this help? Would that? And it was incredible. And then getting follow-up from them about like the things we talked about. HUD and FHA, same thing. We got to listen to Secretary Turner, and he like came in and talked about it. Man, the head of HUD like went to manufactured home dealers and walked into the properties.
Wow.
Prior to this meeting to see and feel and live what is in those things. And he came back, he was like, those things are awesome. You know, he was like talking about it. We were in shock that he was that in the weeds and got into it to understand it so we can have a conversation to understand how this works. And the changes are coming. I've never seen an administration or this regime so accepting of our feedback and saying, yeah, that doesn't make any sense. And we had Ginnie Mae in the room. It was, FHA and Ginnie Mae were there. We talked a ton about all these little things that would make it easier to be able to securitize these loans, and really providing some liquidity for a market that could potentially solve some of the affordability crisis that we're in, especially in certain areas, not just rural, but we're talking about areas, some urban areas and suburban areas that could benefit from the type of construction these things are. So incredible dialogue. Again, really open, and there's going to be changes. There's going to be changes in USDA. You're going to see some significant changes in USDA. It's going to be a product that's going to be out there and getting more share. I would highly recommend paying attention to that as we go. There's going to be a lot of changes. Just saw some mortgagee letters. Literally, it was perfect timing. So we went and met on a Tuesday. That Friday, FHA made a bunch of changes to how their appraisal stuff is on our side. We loved it. They made it a lot easier, less restrictive for FHA appraisals. A lot of the red tape was lifted. So that's the kind of movement and progression we're going to see. And it's really odd. And we talked about it. A lot of these agencies don't really talk to each other. So having talked to Freddie Mac this past week in California, having to talk to HUD and USDA and FHA, like there was a battle in the prior administration for a certain type of loan, this affordable loan. And there's been a battle for them, a lower FICO, lower income. Like they were like FHA's numbers, their debt to income skyrocketed. And I'm like the idiot in the room that stared at the numbers before. So I like raised my hand. I'm like, isn't that just because the fact that if it's below like a 45, if it's a 45 ratio or below, like they're just going conventionally now because you get to waive LLPAs and do the stuff to affordable products. And they're like, we'll have to get back to you on that one. And you're like, well, like I'm using my common sense gene here, guys. Like these people have been battling for the lower credit scores and lower income loans for quite some time. And then we all know that if you can put 3% down in one of the affordable products, it's going to be better for them, especially with LLPA waivers, than it is to put an FHA. So the government cannibalized those loans, and that's why you're seeing a little bit higher delinquency rates on FHA. It's because they've had higher DTI, and we know with inflation, it's been harder to pay. So those are the things that you see there. And but there's changes that are coming. They are listening and they're moving. And I will say it's not all talk. There is action. And when you see action on things that they can control, there's things that have to go to Congress, but in things they can control, we're going to see significant action. Your conversations with Pulte from the FHFA side of it, which we'll touch on now. I would definitely want to talk about that one real quick. But you'll see that he's a man of action, even sometimes, firing, before aiming.
Yes.
Like we just did with Vantage scores.
Yeah. Yes. Which is a whole nother conversation, which we can touch base on briefly there. But this is exciting news. It sounds like for the originator and the broker, just to hear you say that they're getting in the trenches. And I do believe personally, regardless of political affiliation or what you believe in, I do believe it is in turn because of what we're seeing in terms of a shift from this regime, whatever you want to call it, where they are really focused on affordability. They are focused on housing. And whether Pulte is out there with the tweets or whatever that case might be, or the X, whatever they call it now, to your point, it sounds like people are in the trenches. It sounds like they're trying to learn and figure out what's going on. It sounds like they're listening to people like yourself that are on the ground level. And I don't know when the last time we've had that, just from me in the space 13 years now. So is this a new shift for you even as well, seeing
It
all of this?
is. And I was
That's
so
awesome.
funny because like they wanted to listen to folks, and I have I'm incredibly blessed to have the role that I have. I have my dream job, right? I get to run an organization, but I also have, as you mentioned kindly, my ties to origination in the front end of the business, and how recent, and kind of having lived it. Granted, I was not a great originator, but the team was good, and the things I got to oversee, it all was helpful in this, and being one of the few people in the room that was that close to the origination side, that still understands how things get disclosed and still understands the pain points of delivering and the underwriting issues and things that we have. Not talking from 50,000 feet, and that's why I think they gravitated towards my comments and questions, because they were built on the front lines, and they didn't want to talk to the guy that hasn't looked at a loan in 25 years and sits back and runs a great company. There's a lot of people that ran great companies there. They did want to know and followed up about what it's like in the trenches, what it's like dealing with them, what it's like responding to letters, what it's like to do things on the front end. And I was taken back. I posted about it on LinkedIn even. I was like, I'm taken back by the way they approached it, the way they were willing to move, and then the action behind it. It was really important, because you could do all that and take all the fluff stuff. I've seen that from the agencies before, but to come back and then send a follow-up, a note, an email saying thank you. So like, it's supposed to go the other way around, where I'm sending out notes and thanking them. They're sending notes saying thank you. Would love to hear more about this. Can you work with this person and get this information over that we talked about? So just seeing the action is a big deal.
People are on edge, my friend. People are wanting to get back involved and dialed into our process here. All right. So one of the other areas that you and I have touched base on before is FHFA directly. So I did get the great opportunity to sit down with him for dinner in Mar-a-Lago, and shout out to Barry Habib. Thank you for putting that together. That was fantastic. And just to touch briefly on it, it was cool. To your point, he is very just progressive. He wants to see change. He understands the business. He knows what's going on. Granted, he gets aggressive with certain things that he wants done right away, but I just love seeing that there's real focus and shift on this change. But can you just touch base briefly on FHFA, what it actually is, what the oversight means, and how it's not directly connected to the CFPB as so many people think it is?
Yeah, or FHA, right? So I
Yes.
get that a lot too. It's I think they did the acronym just to mess with us. But yeah, so basically FHFA has it's agency created to have oversight of the GSC since they went under conservatorship. So they kind of have one oversight group, and a lot of the things that we think Fannie or Freddie control, they don't. And I learned that this week when I was questioning certain things in terms of agency profitability, why they don't just cut G fees, and like there are so many pieces to a Freddie, and when I've spoken to Fannie about certain things, they're very quick to remind me that is directives from FHFA. So their mandates, their mission, they use mission a lot in their terms. That comes from FHFA. It's an oversight group for the GSEs until they become private, which we talked a little bit about in prior sessions. It's probably not going to happen short term. So FHFA is here to stay. We were joking off camera a little bit about some of the comments that we see when Jonathan was going to go meet with him or had met with him. It's like, oh, ask him about LO comp or ask him about this, and it's like, okay, I mean that's not quite what they do. So so when it's conventional loans, FHFA, loan limits, guidelines, changes, pricing, LLPA discussions. That is Bill Pulte and FHFA. When it comes to LO comp, when it comes to rules and regs, and God knows that we have like 5 different definitions on our side of what an application even is based on the different regulations. When it comes to that, that's CFPB still, right? So CFPB has shrunk significantly. We get that. That means enforcement has shrunk. However, have you guys seen how many rule changes have happened at the CFPB? It's like none. So the rules are still there. The guidelines are still there. And from a lender perspective, it's like, well, if someone asks like, well, they're going to change that. Who cares? Administrations don't stay on forever. if things were to switch and change and there's a different mindset for the CFPB, they can go back to this time period of time because the rules haven't changed. They're looking at things, but the rules haven't changed. That's why lenders have to still be cautious, even though, yeah, enforcement's going to be down because they have like 3 people working there. But it's going to be the fact that that is today. It's just like when you read your contracts and when you look at stuff with vendors and you look at things, you always want to look and see what's the period of time they can come back to you for something. And that's always in there. And you want to look at that, and CFPB has the opportunity to come back for a long time and come after you for certain things that you've done. So you want to make sure you do things within the rules and still follow them to the interpretation that you've been given last.
I appreciate you sharing that as well, because yes, there's a lot of people changing their policies already without actually policy changes occurring from the CFPB side. I would cautiously tell you to take the path that he is talking about right now. If you are a business owner, broker owner, just be very cognizant of it. Just ensure that you're setting your company up for success, and just know a little bit about what's going on. To his point, right? FHFA, CFPB, where are these oversights dealing with? Because if your loan officers are asking you questions and you're a broker owner and you can't guide them down the right path, it won't be a good look long term. I'm just telling you right now. And if you don't know, reach out to Rob. Right? Just get in front of him. He's more than willing to talk to anybody and everybody when it comes to conversations that are surrounding this wholeheartedly. He's just a huge advocate for us, y'all. And we're watching him comment every single time on Brokers Are Best when it comes to anything around their experience around AFR or anything even going down the sections of FHFA, of HUD. He loves being involved. He's always in the trenches. Rob, cannot thank you enough for this. Do you have any final thoughts for us before we close this out?
Yes. One last thing I'll say is, the broker community isn't represented enough. And I don't take it lightly when I get invited to these things, because I will tell you, holy cow, we're outnumbered. Okay. You have a lot of people with a lot of different agenda items. We had the Community Home Lenders of America post a letter about LO comp to the CFPB about changes to it. And I could not believe what was in that letter about broker community. Hey, they caused the crisis and now they get lax ability for compensation, this and that. I was taken back and in shock of a trade association that we should be working hand in hand to get something like LO comp solved for all channels, regardless of type of delivery that and method and the way you run your business. But really, the origination doesn't change for anybody. And to hear that kind of language, and it's really important for us to continue the advocacy, and then when I get a seat at the table and get to talk to that, and I look around the room and there's 25 executives from 25 companies, and like 23 and a half are retail, and significant retail shops or builder shops only. Getting an opportunity to voice, maybe I'm not always the best person to voice it. So, we're not doing the bajillion dollars of volume, but we get an opportunity to talk about it. They listen. It's a huge segment of the business. The market share has grown, and getting an opportunity to be the voice for the broker channel, I don't take it lightly, and it's probably one of the most favorite parts of my job when I'm out there talking to the agencies, talking to whoever will listen, basically, and representing the broker community. I do it from the seat of a broker originator at some point and having lived it, and then also from a lender perspective, why we want to continue to push the channel and really make, because we do truly believe, I will say it today, I believe wholeheartedly, not just because that's how I get a majority of my business, but wholeheartedly, it's why we chose the channel. When we purchased AFR, we could have gone any direction we wanted, and we chose this channel. So we truly believe it's the best place for a consumer to get a loan. Most loans, right? There's certain segments that are there, but having that opportunity to talk to the agencies and represent the broker community really is something I look forward to continuing to do it as well. And it's one of the things that I love about my current role.
Rob, we, I remember the first conversations we had as I entered into my new role at AIM, and I'm appreciative just to see how our relationship has grown and just to see what AFR has done as well. It is very apparent why there's been a really giant shift in the perception of AFR And I know it's top-down leadership, and I know you'll thank your team every step of the way, and we know they're doing an incredible job. But we also want to thank you for your commitment to this community, for you traveling around, having the difficult conversations, and just being in the trenches with us every single step of the way. AFR has been a huge partner, not just for AIM, but for my company as well, that I'm still fortunate enough to run. So y'all, this is our secondary session. Episode 3 of this. There's so much to unpack here. We're going to give it to you in bite sizes, but we're also going to give this to you long form so you can sit down, listen to it, and really understand how things work on the back end. The more you understand, the more educated you are, the easier it is to explain, and the more understanding you can be when things go a little south sometimes because of the space that we're in. He gave us a lot of information. We're excited to share with all of you. We cannot thank you enough. Cheers until next time, my friends. Take care.